This conference will now be recorded.
So let's review what we worked on yesterday, which is merchandising companies and inventories. And the key thing that we said was that when you sell inventories, there's 3 journal entries, uh, a 12 journal entry when we type 12 when we buy the inventory. And we always use a type 12 typically because number one, if you're buying a lot of merchandise, and you got to make sure it was delivered to you. And of course, you typically are not paying the delivery driver. So this is a standard entry. You debit inventory and credit accounts payable. Then on the sale of the inventory, there are 2 transactions. First of all, the normal sale that you're familiar with, either 2 or 15. But then there's a type 16 where we transfer the inventory purchase to cost of goods sold. And our goal is always to determine the profit. We're using a perpetual inventory method where we're keeping track of the inventory as it's sold, and that's typically done in most cases. But a key thing here, if you sell something that you bought, it's no longer an inventory, so you debit cost of goods sold and credit inventory with the hope that you made a profit. We looked at the income statement that you're supposed to be working with now: sales less returns and allowances, net sales, less the cost of goods sold, your gross profit. Then the operating expenses that we've worked with before to get our net income before taxes, then our federal income taxes, our net income after tax. In your closing entries now, you have to close out cost of goods sold, the operating expenses, and the federal taxes if you're going to have the correct ending retained earnings. All of these have to be closed out: cost of goods sold, core sales returns and allowances, the operating expenses, the federal income tax. All of those have to be closed out. And we looked at this example and we said the goal was, if we bought a shoe for $50, what's the cost? Did we make a profit? Selling price less cost give you gross profit. And that's always our goal. And then we mentioned 3 inventory methods: FIFO, LIFO, and weighted average. And we're working on FIFO today. You have a quiz on FIFO shortly. You have about 45 minutes for that quiz, and then we're going to go on the LIFO and weighted average. Then you have a quiz tomorrow, uh, probably for the last hour or so, on FIFO, LIFO, and weighted average. And we stated yesterday, if you had issues with FIFO today, that's fine. You just have to get it correct by tomorrow. But everybody seems to be saying they got this down. So with FIFO inventories, we always are looking at a situation where with our shoes coming in, they're loaded as they come in, and when they're unloaded for distribution, the person unloading the shoes always takes the oldest shoes first because that's what's closest to him. So this is how FIFO operates. The oldest shoes are sold first, and the newer shoes at the back of the warehouse. This is the front of the warehouse. So that's the philosophy behind FIFO. We also talked about the fact that, okay, we want this, we're just looking at the top of the income statement. Sales less cost of goods sold equals gross profit. And then we talk about this inventory flow chart, which is when we have a lot of transactions and a lot of inventory items. We're going to keep track of it with the inventory flow chart for each item, where with beginning balances, we put them in, then we make a purchase, we transfer that over. These are our journal entry 1 tax it, course 12, but in inventory cycle 1, whenever we make a purchase, we transfer it to the balance. And then we have our journal entry 15, which is type 3 in our cost of goods sold cycle, which comes out of this middle column. Whenever we are selling something, we determine what was sold. And I think in this case, we sold 150. So we had to come up and determine the cost of what's sold. And that balance is what's left. And typically, these will be set up on a minimum order quantity so that once you get to a certain quantity, the inventories are automatically ordered. And the journal entries type, the first one, the purchase journal entry, the sale the journal entry, and the recording the cost of goods sold. Are there any questions on what I've said so far? Are there any questions? What about the homework problem I gave you to work on? Did anybody have any problems with this? So everybody was able to do it.
Yes, sir.
Well, I don't guess we need to go, so we can just go on to the quiz, I guess. But just in case. The beginning inventory was 2,000 pairs at $20 each. And this is where meeting every day helps, because if you have been away from this 2 or 3 or 4 days, it's more difficult because you hit it the next day. It's a help. And so with the beginning inventory, we lifted this 2,000 pairs at 20. And we put that on our inventory chart. 2,000 pairs at 20, $40,000. So that's the first thing on our inventory chart. Then we purchased 2,000 pairs at 25. So two things happened. Well, one thing happened. We debit inventory and credit accounts payable. And we're using this journal, and we'll see why a little bit later today. And once we purchased the inventory, we did what? We did do a second thing. We put that inventory in the purchase section of the inventory chart, and then we transferred it over to the ending balance. So in our inventory now, 2020, 2025, 4,000. And our first sale was a cash sale of 1,000 pair for $100 each. So now we know we need 2 journal entries. The first journal entry records the sale of $100,000, $1,100 each, $100,000. And we said when we made that sale, then we would go to the T account for sales and put in the 100,000 sale. Because at the end of the day, you're going to come from that T account to answer the question, what was sales, what was cost of goods sold, what was gross profit. Then we had a second sale on account, 2,000 pairs at 100. And so I think we did this for you. It was 2,000 pairs at 100. That was 200,000. So we debited account receivable, credited sales for 200,000, and we carried that also to the sales T account. Now let's go back to cost of goods sold. To determine cost of goods sold on the first sale, to get, these are the standard journal entries. We're going to go to cost of goods sold. We're going to go to our inventory chart. And we sold 1,000. We're going to sell these first. And so we bring down 1,020, that's $20,000. And so in this journal entry comes the 20,000 for cost of goods sold. That leaves us with 1,020, 2,025. So when we sell another 2,000, we're gonna sell this 1,020 first, 20,000. Then we're gonna sell 1,000 of the 25. So our total sale is 45,000. We add these two together. And now left in inventory is simply 1,025. And so the 20,000 and the 45 are placed in that journal entry for cost of goods sold, and they're placed in the T account on the cost of goods sold FIFO. Are there any questions? Okay, well, lead me through. We purchased 4,000 pairs at $30 each. What are we going to do? What's our journal entry?
What number y'all on? I'm sorry.
What number we on? We
3.
on number 5. So we purchased 4,000 pairs at $30 each. How much is that? I thought y'all done the homework.
Yeah, I got it for 120,000. If I purchased 4,000 shoes for 30 at 30.
That's what I thought.
120. I mean, I ain't the only person who did the homework though, am I?
Awesome. Unavailable.
Okay. And so now we need to put into the T account what? Excuse me, into the inventory chart.
Inventory debit 120,000, accounts payable 120,000.
We made the journal entry. Well, let me come down, son. So we got 4,000 in here at 30. So that's 120,000. And whenever we have a purchase, we transfer what's here
To the total ending balance side.
ending balance. So now we have 1,025 and 4,030. And of course, that journal entry has been made. Then we had a sale on account of 3,000 pairs at 100. So when that happens, that was a sale on account. So
cash debit.
we have to copy these. So on the sale, we've got these journal entries to make all the time. We got to do the sale and the cost of goods sold. So what was the sales amount?
300,000.
3,000 at 100, 300,000. So we're going to debit account receivable, 300,000. Credit sales, 300,000. Then what are we going to do? We're going to take that 300,000 and put it down here with sales. So we got that T account to come to make
Right, bring me
sure
my coffee.
to accumulate the cost. Now, we now have a sale of what, 3,000 units, right? So we're gonna sell what?
We're gonna sell 1,000 at 25. And then we're gonna
So
sell
that's
2,000 at 30.
5,000. All of those are gone. So all of these are gone. Then we're gonna, since we sold 3,000, we're gonna sell what? 2,000 at what?
1,030 for a total of 60,000, giving our COGS a total of 85,000.
So our total is gonna be 85,000. And so with this 85,000, and at this point now we know what, with our inventory left, we simply have 2,000
At 30
at 30,
for
so
60,000.
60,000. We're gonna put this 85,000 in that journal entry, the cost of goods sold. And then we're going to put this 85,000 into the T account for cost of goods sold, so that we can easily come up with the profit that we made on the sale. Now we have another purchase, correct?
Yes, of 4,000 at 40.
We're purchasing 4,000 at 40. So then the standard journal entry comes in.
Inventory debited 160,000. Accounts payable credited 160,000.
I'll take your word for it. Then we're going to do what? Go to the inventory chart and put what, 4,000 at 40?
Mm-hmm.
So we got 4,000 at 40. So that's 160, correct?
Mm-hmm.
And then we transfer this over. And so now we have in inventory 2,030, 4,000 at 40. Then we have a cash sale, correct, of 4,000 at 100. That's our final transaction. A cash sale of 4,000 at 100. We can come in here and copy these. Copy. So we got two journal entries to make.
The first one is for
For the cash,
400,000.
how much cash we getting?
100,000.
How much cash we getting?
400,000.
400,000, okay. So we're gonna debit cash for 400,000 and credit sales for 400,000. Then we're gonna take that sales number
Put it in the T account.
and put it in the T account. Now we gotta go through and go now and come up with our cost of goods sold in this middle column. So we know it's 4,000 that we sold. So it's going to be what? 2,000
at 30,
30.
then the other 2,000 at 40.
Then we'll have 2,040. So that's 80,000. So what's our total? This is going to be what, 140,000?
140,000.
And left in inventory at this point is going to be what? 2,000 pairs of shoes at 40, $80,000. We take the 140, we put it in our journal entry. And then we go to our T account and put the 140 for the cost of goods sold in. So if I add up all the credit sales, how much are the credit sales at this point since we're finished? Got $1.2 million?
Million.
$1 million?
Mm-hmm.
Okay, that's $1 million. How much are our cost of goods sold?
$290,000.
40, 85, 45, and 20. How much is that?
$290,000.
I'll take your word for it. We don't have Excel here. So we got $1,290,000. So we take those numbers to answer the key question. What were our sales? $1 million. What was our cost of goods sold? $290,000.
Gross profit 17.
The gross profit was $710,000.
Yes.
Are there any questions? Can everybody do this?
What is the other two columns? It's FIFO, and then what's the other one? The other two.
LIFO and weighted average.
LIFO
Not
and
worried
weighted
about
average.
those yet.
Hold on, wait a minute. What did
All
y'all
you
say?
got to do is do this left column.
Okay, so the other two don't matter
Not
right
yet.
now.
Right now.
Okay, so that whatever we about to do today, everything will go in the left column.
On your quiz,
Oh, that ain't.
Yeah,
which is an assignments, which you should be able
yeah,
to access.
I saw it.
You saw it.
I
Who
mean,
told you to look early?
I heard you. I was listening, but
Just talking, Crystal.
I heard you. So I mean, I'm gonna try to do it.
Try to do it.
Yeah.
Okay, so I'm gonna give you on to 11:30. Is that enough time?
You scroll down to the journal entry real quick. I just want to see everything again. Thank you.
They are. Journal entries never change for what we're doing now. Is either we buying the inventory, one journal entry, we selling the inventory, two journal entries.
This conference will now be recorded.
Okay, let's see where we are. With the homework that you've been assigned, what you did before, we will now work that homework using LIFO and FIFO. So let me see. It's gonna act okay. Okay. So LIFO assumes the latest goods purchased are the first to be sold. So if these were the latest ones and these were the older ones, then LIFO will assume that you're selling the latest ones. So assume we purchase 100 pairs of shoes for 15 and 200 pairs of shoes for 20, and we sell 150. So if we were using, and let's just put these on the inventory chart. Let's see if I have them back here. So if you will remember when we were doing FIFO and we worked this out, there's 115 and 220, we moved those over. And then when we did the sale, we sold the old 100, and then we sold a new 50. And so our cost of goods sold on the FIFO was the oldest one sold and then these. So that's how FIFO worked. We made our journal entries. Now, if we take this information and we go to LIFO, okay, so we have the same information and we're going to LIFO. When we sell the 150 pairs of shoes, when we sell the 150,
We're gonna sell them at $20.
we're gonna sell them at the $20, the oldest cost. So when we make that sale, one week starting at the bottom now, we're gonna sell 150 of the $20 ones, and so our cost of goods sold now is going to be $3,000. Okay, and what you're going to have left in inventory at this point, you're going to have 115. So all these old ones are still there. And you're going to have 120. So with LIFO, then we start from the bottom. FIFO, we start from the top. LIFO, we start from the bottom. Any questions? Now, if we make the journal entries, what we're going to find is that the first three journal entries stay the same. So when we go to there's no change in the journal entries. The only journal entry that's going to change is cost of goods sold. So whereas cost of goods sold on the FIFO was $2,500, cost of goods sold on the LIFO is $3,000. And so the cost of goods sold is going to be $3,000. And so now when we do our sales and our gross profit, it's going to be sales of $6,000. Cost of goods sold is going to be $3,000. And the gross profit is going to be $3,000. Okay, so when we did the profit for FIFO, it was 6,000 minus 2,500, 3,500. But when we did it for LIFO, sales the same, cost of goods sold is 3,000, and so the gross profit was 3,000. So depending on how we cost the items, sales stays the same, the cost of goods sold and gross profit changes. Because LIFO and rising prices is going to produce a higher cost of goods sold and less gross profit, a lot of time manufacturers want to use this, producers, because they will pay less tax. So they're going to choose LIFO and try to have a cost flow that way. Because in rising prices, the gross profit under LIFO is going to be less than the gross profit on the FIFO, resulting in less taxes. And most times prices are rising. So you can choose FIFO or LIFO, but the results are going to be different for the cost of goods sold only. Now let's go to weighted average. Let's go to weighted average. In a weighted average, and this just shows how you calculate a weighted average. This example, we add up all units, we add up all the costs, and then we get an average based on total cost divided by total units. So that was 11.4. So just looking at that, and when we do weighted average, we're going to add up the units, we're going to add up the total cost, and we're going to get an average. Let's see how that works in our simple problem where we were purchasing 100 shares. Well, excuse me, 100 pairs of shoes at 15 and 200 pairs at 20. So let's go and see if we can pull that information in again. So we're pulling in the same information on the purchase side. We're going to copy. Let's see if I got a blank flow chart. So let's assume this is weighted average here and we paste it. Okay. So we made the purchase. And we transfer them over. Now, when we do weighted average, we come in here and we scratch out these two costs. We're not going to use the beginning cost. We're not going to use the ending cost. We're going to add up our quantities and get 300. We're going to add up our total units and we're going to get 5,500. And if we divide 5,500 by 300, what do we get?
18.33.
Take your word for it, 18.33. So when we get ready to make that sale, and how many did we sell? 150.
Yeah, you're gonna tell it at a unit cost of 18.33 for a total of 2,750.
So we're going to use 18.33. We're not going to use the first cost. We're not going to use the last cost. We're going to use this average. And how much did you say this was?
2,750.
So this becomes 2,750. So, and that's going to be the cost of goods sold. And so when we come to our problem and we look at gross profits, notice an interesting thing with rising prices. With FIFO, we have the highest gross profit, smallest cost of goods sold, with rising prices. With LIFO, we will have the highest cost of goods sold and the smallest gross profit. With weighted average, it's always going to be in between. It might be the same, but at least it's going to be between. That is, the cost of goods sold is going to be between these two, and the gross profit is going to be between these two. And so when that situation is not existing, then maybe you did something wrong. When that situation does not exist, then that can be a check for you to tell you, well, maybe I did something wrong. Now, as we look at this example on the FIFO, LIFO, and weighted average, notice that the journal entries, number one, the buy, the inventory stays the same under all three methods. So this is why I set the journal up this way. Once you got it on the FIFO, you got it on the LIFO and weighted average too, the amount of the purchase. So the purchase journal entry stays the same on the FIFO, LIFO, and weighted average. The sales journal entry stays the same on the FIFO, LIFO, and weighted average. So once you got the sales amount, you got it. The only journal entry that is changing is type 16, the cost of goods sold. So that changes, but everything else stays the same. And as we said, so the sales going to stay the same, cost of goods sold is going to be different, typically with weighted average in between. And the in rising prices. If there were falling prices, these would reverse, but we'll work with the rising prices. And notice those gross profit. Are there any questions? Are there any questions? So let's go back to that problem that you were working on. And your task for the rest of the day is to finish the problem on the LIFO and weighted average now. To finish this problem on the LIFO and weighted average. And see what you're going to get for the gross profit on the LIFO and on the weighted average. As I said, for your work, the purchase and sales journal entry stay the same. The only journal entry that's changing is this cost of goods sold. That's going to be different. Every time you have cost of goods sold, then you know you need some different numbers. But if you don't have cost of goods sold, then you've already done the work. Is that clear? So all you're doing is calculating cost of goods sold. You've done all of the other work. You just have to transfer them over. So it should not take you long to transfer your numbers over. So you don't have much work to do. So you should be able to finish this up before you leave today. Okay. So you got to do a flow chart for LIFO. You got to do another one for weighted average. So the flow chart changes. When we get to the T accounts, the sales T account is done. You don't have to change anything. The LIFO and weighted average T accounts have to be done, but the sales is already done. Are there any questions?
I do. If because I thought that was homework. So if I already did all of that, what do you want me to do?
Then go to the exam that you just took and work it for FIFO and LIFO, which is
I submitted that already for all three parts.
you did it for
But
all
okay,
three parts.
yeah, I'll go back and look over it though, just to refresh my memory. It's fine.
I tell you, what we're gonna do with it? What we're gonna do with it?
Yesterday you said that A students, meaning me, Darius, and Crystal, was supposed to do the LIFO, FIFO, and weighted average.